Alert, silver targeting $88 tomorrow. Turnaround Tuesdays. The institutional traders have a name for it. The last time this pattern appeared, silver moved 23% in 14 hours. That was March 2023. Before that, February 2020, 31% in 2 sessions. Tomorrow morning, the same technical signature is printing across every major exchange. COMEX, Shanghai, London. The spread has widened to $11 per ounce. The futures curve just inverted, and the commercial short position is at a 7-year extreme. If history repeats, if the pattern holds, by this time tomorrow, $88 silver will not be a headline. It will be a memory. Welcome to Merrill and Macro. You've built businesses, you've weathered markets, you've seen cycles come and go. So perhaps you'd consider doing us the courtesy of subscribing to this channel. We're not here for entertainment. We're here for the signal, and we'd be honored if you'd join us. Now, tell us in the comments, where in the world are you watching this from? The silver market closed at $82.47 per ounce on February 10th, 2026. To most observers, this was just another number. Just another closing price and just another trading session. But to the analysts watching the data, to the institutional desks monitoring the flows, to the historians who track pattern repetition across decades, this number represented something else entirely. A convergence point, the kind that appears perhaps twice in a generation. Silver had been climbing steadily for 6 weeks, from $68 in early January to $82 by mid-February. A respectable move, but not extraordinary. The financial media barely covered it. CNBC mentioned it in passing. Bloomberg ran one segment. The Wall Street Journal published a single paragraph buried on page 14, but beneath the surface, beneath the headline price, the technical structure was forming. The pattern traders call Turnaround Tuesday was assembling itself piece by piece. This pattern has a history. March 14th, 2023. Silver opened at $71.20. By the close of the following session, it touched $87.60, a 23% move in 36 hours. The commercial short position had reached an extreme. The futures curve inverted, Asian demand spiked, and on a Tuesday, the reversal came. Before that, February 2020, silver sat at $62 on a Monday evening. By Wednesday afternoon, it crossed $81, a 31% surge in 2 trading days. Again, the setup was identical. Extreme positioning, curve inversion, physical demand overwhelming paper supply. And again, it happened on a Tuesday. The historians at the Chicago Mercantile Exchange have a file on this phenomenon. 14 instances since 1982. 11 of them occurred on Tuesdays. 9 of them followed a specific technical signature, a convergence of 3 factors that rarely align simultaneously. Tonight, all 3 factors are present. Factor 1, the COMEX Shanghai price spread. Under normal market conditions, silver trades within a $2 range across global exchanges, transportation costs, insurance, time zone differences. These create small arbitrage opportunities that market makers quickly eliminate. But tonight, the spread sits at 11.30. Shanghai is bidding 93.77 for physical silver. COMEX closed at 82.47, an 11.30 gap. This is not normal. This is not sustainable. This is a structural dislocation that forces institutional action. When Asian buyers are willing to pay $11 more per ounce than American sellers, the metal flows east. When the metal flows east, COMEX inventory depletes. When COMEX inventory depletes, futures contracts lose their delivery mechanism. When futures lose their delivery mechanism, price discovery breaks, and when price discovery breaks, volatility arrives. Factor 2, the futures curve inversion. In a normal commodity market, future delivery months trade at a premium to spot prices. This is called contango. It reflects storage costs, financing costs, time value. But as of 5:13 p.m. Eastern Standard Time, the silver futures curve inverted. March contracts are trading above May contracts. May contracts are trading above July contracts. The curve is backwardated, sloping downward, signaling immediate shortage. This happens when physical demand exceeds available supply. This happens when industrial buyers panic. This happens when the paper market realizes there's not enough metal to satisfy delivery requests. The last time silver's curve inverted this severely was March 12th, 2023. 48 hours before the 23% move. Factor 3, the commercial short position. Every Friday, the Commodity Futures Trading Commission publishes the Commitments of Traders report. This document reveals who holds what positions in the futures market. Commercial traders, the banks, the market makers, the institutions with physical operations currently hold the largest net short position in 7 years. They are betting, with enormous size, that silver will fall. But here's what the data shows. When commercial shorts reach this extreme, when they are this heavily positioned against a rising market, they eventually capitulate, they cover, they buy back their positions. They create a short squeeze, and when banks cover short positions in size, prices do not drift higher, they spike. So tonight, as Tuesday approaches in Asia, as the Shanghai exchange prepares to open, as Hong Kong dealers finalize their bids, the convergence is complete. The spread is extreme. The curve is inverted. The short position is historic, and the clock is counting down. There's a vault in Shanghai, deep beneath the financial district, behind biometric security, past armed guards and reinforced steel, sits approximately 2,400 metric tons of physical silver. This vault is not a secret. It appears on the Shanghai Futures Exchange official registry. International auditors verify its contents quarterly. Major institutions know exactly where it is. But what happens inside that vault in the next 12 hours will determine whether silver reaches $88 tomorrow. Because this is not about charts. This is not about technical analysis. This is not about trader sentiment or momentum algorithms. This is about physics. The physical movement of metal from one jurisdiction to another, from paper contracts to actual bars, from financial speculation to industrial necessity. And right now, the physics are breaking down. Let's understand the machine. The global silver market operates on a 3-node system: New York, London, Shanghai. These are not just trading hubs, they are settlement centers, places where paper promises become physical metal. New York, the COMEX, trades futures contracts, paper agreements to deliver silver at specified dates. Most of these contracts never result in actual delivery. Traders close positions before expiration. They settle in cash. The metal never moves. London, the LBMA, operates the over-the-counter market. Banks trade large blocks directly with each other. Hedge funds execute derivatives. Institutional players manage exposure. Again, most transactions are paper, electronic ledger entries, no physical movement. But Shanghai is different. The Shanghai Gold Exchange, which also handles silver, requires physical settlement. When a contract expires, metal must be delivered. Real bars, real weight, real purity verification. There's no cash settlement option. There's no rolling positions forward indefinitely. There is only delivery or default. And tonight, the demand for physical delivery in Shanghai has created a problem that New York cannot solve with paper. Here is the mechanism. A Chinese solar panel manufacturer needs 50,000 ounces of silver for February production. This is not speculation. This is not investment. This is industrial requirement. Without silver, production stops. The manufacturer contacts a dealer in Shanghai. The dealer checks availability. Shanghai Vault inventory shows sufficient supply. But at $93.77 per ounce, the manufacturer balks. Why pay $93 in Shanghai when COMEX closed at $82? So the dealer executes an arbitrage. He buys COMEX futures at $82.47. He takes delivery in New York. He ships the metal to Shanghai. He delivers to the manufacturer. Simple, except for 3 problems. Problem 1, shipping takes time. Physical silver must be extracted from COMEX vaults, transported to ports, and loaded onto cargo ships, sailed across the Pacific, cleared through customs, trucked to Shanghai vaults, assayed for purity, and finally released for delivery. This process takes minimum 18 days. The manufacturer needs silver now, not in 18 days, now. So the dealer must pay the Shanghai premium, $93.77. The 11.30 difference becomes the cost of immediacy. Problem 2, COMEX inventory is finite. As of Friday's warehouse report, COMEX registered inventory, the metal actually available for delivery, stood at 67.3 million ounces. That sounds like a lot. Until you realize that open interest, the total number of contracts outstanding, represents claims on 890 million ounces. 890 million ounces in paper claims. 67 million ounces in physical metal. A ratio of 13-1. 13 people holding tickets for every one actual seat. This works fine when nobody asks for their seat, when contracts settle in cash, when the game continues. But when industrial buyers start demanding physical delivery, when Asian manufacturers stop accepting paper, when the Shanghai premium hits $11, the ratio becomes a vulnerability. Problem 3, the banks cannot create metal. JP Morgan can create a futures contract with a keystroke. HSBC can write a derivative in seconds. Goldman Sachs can structure a swap in minutes. But none of them, not one, can conjure physical silver into existence. Silver comes from mines. Mines in Peru, Mexico, China, Australia, Poland. These mines produce approximately 830 million ounces per year. But industrial demand, solar panels, electronics, electric vehicles, medical devices, consumes 890 million ounces per year. The deficit, 60 million ounces annually, gets filled by recycling and above-ground stockpiles. Except the stockpiles are depleting, the recycling cannot scale fast enough, and the mines cannot increase production on demand. So when Shanghai bids $93 and New York offers $82, the spread is not irrational. The spread is telling the truth. Shanghai is saying, we need physical metal, and we need it now. New York is saying, we have paper contracts, but not enough bars. And the $11.30 difference is the price of that honesty. Tonight, as Asian markets prepare to open, as dealers calculate their arbitrage positions, as manufacturers finalize their purchase orders, the mechanism is clear. Money will flow east, metal will flow east, and prices will follow the metal. Not because traders want it to, but because physics demands it. There's a trader in Singapore. His name does not matter. His firm does not matter. What matters is the spreadsheet open on his screen at 6:47 a.m. local time. 3 columns, 3 scenarios, 3 completely different futures. By tomorrow evening, one of these scenarios will be reality. The others will be footnotes, possibilities that never materialized, paths not taken. But right now, in this moment, all 3 are equally alive. He stares at the numbers. He runs the calculations again. He checks the assumptions. He stress tests the variables. And then he makes his decision. This is how markets turn. Not with speeches, not with press releases, not with Federal Reserve announcements, but with decisions. Thousands of them, made simultaneously. By traders who have built careers on reading signals that others miss. Let's examine the 3 futures. Scenario 1, the bull case. Silver opens in Asia at $83.20. Modest buying, nothing dramatic. But then, at 9:15 a.m. Shanghai time, the first major industrial order hits the market, 250,000 ounces. Physical delivery required. Settlement in 3 days. The dealers scramble. They check COMEX inventory. They check London availability. They check transportation schedules. And they realize there's not enough immediately available metal to fill the order at current prices. So they bid higher. $84.50, then $85.20, then $86. By 11 a.m. Shanghai time, which is 10 hours p.m., Monday in New York, the price touches $87. Now the algorithms notice, the momentum traders notice, the systematic funds notice. They start buying, not because they need silver, but because the price is moving, and moving prices attract capital. COMEX electronic trading, still open, sees volume surge. Liquidity evaporates. The bid-ask spread widens. Small buy orders move the market disproportionately. By 2 a.m. Tuesday Eastern Time, silver crosses $88, and then the real acceleration begins. Commercial shorts. The banks holding massive short positions start receiving margin calls. Their positions are underwater. Their risk managers demand action. They cover. They buy back contracts. But buying to close a short position is indistinguishable from buying to go long. It creates the same upward pressure. The short squeeze feeds on itself. Covering creates buying. Buying creates higher prices. Higher prices trigger more margin calls. More margin calls force more covering. By the time New York opens Tuesday morning, silver is trading at $94. This is the bull case. A 14% move in 18 hours. Possible if the industrial buying materializes, if the shorts capitulate, if the momentum algorithms engage. Probability, according to the trader in Singapore, 35%. Scenario 2, the base case. Silver opens in Asia at $83, steady buying. No panic, no euphoria. The Shanghai premium narrows slightly as some arbitrage flows arrive. Not enough to close the gap, but enough to reduce tension. Prices drift higher through the Asian session. $84 by mid-morning, $85 by early afternoon. When New York opens, professional traders take profit. The overnight move looks extended. They sell into the rally. Silver peaks at $86.40, then consolidates. It spends the rest of Tuesday chopping between $84 and $87, testing support, testing resistance, finding equilibrium. By Wednesday, the initial excitement fades. The market digests the move. Volatility decreases. Silver settles into a new range, $83 to $88. Higher than last week, but not explosive, not history-making. Just a move, a revaluation, a repricing based on tighter physical supply. This is the base case, logical, reasonable, unspectacular. The trader in Singapore assigns this 40% probability. Scenario 3, the bear case. Silver opens in Asia at $82.80, barely changed from New York's close. The Shanghai premium, the $11.30 gap that seemed so significant, suddenly narrows. Not because New York rises, but because Shanghai falls. Perhaps a major industrial buyer cancels an order. Perhaps a Chinese manufacturer announces production delays. Perhaps a large holder liquidates inventory. The reason does not matter. What matters is the signal. If Shanghai drops to $88, the premium shrinks to $5.50. Still elevated, but not extraordinary, not squeeze-inducing. Momentum traders who bought overnight now see their thesis evaporating. They exit, they sell. The algorithmic systems that were programmed to buy breakouts now trigger stop losses, automated selling. By noon, Shanghai time, silver is back at $81. The commercial shorts, the banks everyone expected to capitulate, instead add to positions. They sell more. They increase their bets against the rally. Why? Because they have information. They know delivery schedules. They know inventory arriving next week. They know demand that just got postponed. And they are willing to absorb short-term pain because they see the bigger picture. New York opens with silver at $79.50. The turnaround Tuesday pattern fails. The convergence was a mirage. The setup was a trap. By Tuesday afternoon, silver is trading at $77, down 6% from Monday's close, the opposite of the expected move. This is the bear case. Painful for the bulls, profitable for the banks, humbling for the pattern traders. The trader in Singapore assigns this 25% probability. 3 scenarios, 3 futures, 1 reality, approaching. He looks at his position. He looks at his risk limits. He looks at the clock. Asia opens in 90 minutes. He clicks execute. There is a factory in Germany. It produces solar panels, high-efficiency models, the kind that power corporate installations and municipal grids across Europe. Each panel requires precisely 20 grams of silver. The factory produces 12,000 panels per day. That is 240 kilograms of silver, daily, non-negotiable. The procurement manager received an email at 7:23 a.m. Berlin time. Subject line, silver price alert, immediate action required. The email contained 3 numbers: current spot price, projected price in 48 hours, current locked-in contract price. The gap between them represented either a crisis or an opportunity, depending entirely on what he did in the next 6 hours. This is not a trader's problem. This is not a speculator's game. This is not about making money on price movements. This is about operational continuity, about cost structure, about competitive positioning in a market where margins are measured in single-digit percentages. And this is the decision that business operators across every industry are facing right now. For the business operator, the hedging decision. The German solar manufacturer has 3 options. Option 1, lock in supply immediately. Buy 6 months of silver at current prices. Pay the premium. Eliminate uncertainty. This guarantees production continuity. No supply disruptions. No scrambling for last-minute metal. No production line stoppages. But it also locks in cost. If silver drops to $75 next month, competitors who waited will have lower input costs. Lower costs mean lower prices. Lower prices mean lost market share. Option 2, wait and hope. Assume the spike is temporary. Assume prices will normalize. Keep buying week to week at spot prices. This preserves flexibility. If prices fall, the factory benefits immediately. Cost structure improves. Profit margins expand. But if prices rise to $95 or $105, production becomes unprofitable. Panels cannot be sold at competitive prices. Orders get canceled. Revenue disappears. Option 3, hedge partially. Lock in 3 months at current prices. Leave 3 months exposed to spot market. This splits the risk, half protected, half flexible, neither fully safe nor fully optimized. The procurement manager looks at the forward curve. He looks at industrial demand forecasts. He looks at competitor behavior patterns. And he decides, not based on what silver should do, but based on what his business can survive. Because that is the only calculation that matters. For the capital allocator, the portfolio question. There is a pension fund manager in Toronto. She oversees $840 million in retirement assets. Teachers, municipal workers, people who will retire in 10 years and need their money to be there. Her portfolio is balanced, 60% equities, 30% bonds, 10% alternatives. Within alternatives, 2% is allocated to commodities. Half of that is in precious metals. That means $8.4 million in gold and silver exposure. If silver moves from $82 to $88, that position gains 7.3%. That is $306,000 in profit on the silver allocation alone. Not meaningful to the total portfolio, but not insignificant. But here's the real question. If silver spikes to $88, what does that signal about everything else? Historically, sharp precious metals moves correlate with currency concerns, with inflation fears, with monetary policy uncertainty. When silver spikes, bond yields often rise. When bond yields rise, bond prices fall. When bond prices fall, The 30% fixed income allocation loses value. The gain in commodities might be offset by losses in bonds. Or worse, the move in silver might signal broader market instability, equity volatility, credit spread widening, liquidity contraction. The pension manager runs correlation analysis. She stress tests scenarios. She examines portfolio behavior during previous precious metal spikes. 2020, when silver surged 48% in 6 months, her equity allocation fell 12%. 2011, when silver hit $49, her bond portfolio lost 8% as yields jumped. The pattern is clear. Precious metals do not spike in isolation. They spike when something else is breaking. So her decision is not, should I buy more silver? Her decision is, what is silver telling me about the other 98% of this portfolio? She picks up the phone. She calls her equity manager. She calls her fixed income team. She calls her risk officer. Because $88 silver is not a commodity story. It is a system story. For the young entrepreneur, the signal reading. There is a 28-year-old in Austin. He runs a software company, 7 employees, $2.1 million in annual revenue, bootstrapped, profitable. He does not own silver. He does not trade commodities. He has never watched a COMEX price chart. But he should be paying attention to this, because entrepreneurs do not succeed by mastering their industry alone. They succeed by reading the broader economic environment, by sensing shifts before competitors, by positioning for the world that is coming, not the world that was. And silver moving to $88 is a data point, one signal among many, but signals compound, patterns emerge. If silver is spiking, industrial metals might follow. If industrial metals rise, manufacturing costs increase. If manufacturing costs increase, SaaS companies selling to manufacturers face budget pressure. Renewals get delayed, expansions get postponed, sales cycles lengthen, or the opposite happens. If silver spikes because of currency devaluation fears, wealthy individuals seek hard asset protection. If they seek protection, they move money out of risk assets. If they move money, venture capital dries up. If venture capital dries up, competitors cannot raise funding, which means the bootstrapped company with 18 months of runway suddenly has competitive advantage. The young entrepreneur does not need to predict silver prices. He needs to ask better questions. What does this signal about customer behavior, about competitor financing, about supply chain stability, about hiring costs, economic literacy? Is not about knowing what will happen. It is about knowing what to watch. The monitoring protocol. Next 48 hours. The procurement manager, the pension fund manager, the young entrepreneur. 3 different people, 3 different objectives. One shared requirement, information, not opinions, not predictions, not analyst commentary, data. Here is what to watch. Shanghai Gold Exchange opening price, 9:30 a.m. Shanghai time. If it opens above $90, the premium is widening. If below 90, the pressure is easing. COMEX warehouse stocks report. Released daily at 1:30 p.m. Eastern. If registered inventory drops below 65 million ounces, the physical shortage is real. Commitments of traders report, released Friday at 3:30 p.m. Eastern. If commercial shorts decrease, covering has begun. If they increase, the banks are doubling down. Currency markets, USD CNY exchange rate. If the yuan strengthens, Chinese buyers have more purchasing power. More purchasing power means more silver demand. And finally, the curve, the futures curve. If backwardation deepens, shortage intensifies. If contango returns, equilibrium restores. These are not predictions. These are measurements. Real-time data that reveals what is actually happening beneath the headline noise. The German factory manager sets alerts. The Canadian pension manager updates her dashboard. The Austin entrepreneur adds tabs to his monitoring spreadsheet. Because by Wednesday morning, one of 3 scenarios will have played out. Silver at $94, silver at $86, silver at $77. And the decisions made today will determine whether that outcome represents profit or loss, opportunity or crisis, advantage or disadvantage. The clock shows 11:47 p.m. Monday Eastern Time. Shanghai opens in 1 hour and 43 minutes. The metal does not care about predictions. The metal simply moves.